and welcome to the Divorce Lab. We're a group of independent professionals working to help educate the public on various topics related to divorce. I am Carrie Goldring, a certified divorce lending professional who specializes in mortgage planning.
And I'm Mark Avezai. I'm a certified divorce financial analyst. I work primarily in Troy, Michigan.
Hi, I'm Jim Chryssikos. I'm a family law attorney and mediator located in Troy, Michigan. So let's get started with today's show.
So the one observation that I noticed from listening to Ben with my mortgage ears is when someone is trying to show they don't have income because it's going to implement them paying spousal support or child support versus applying for a mortgage, and then all of a sudden the person who said, oh, I only make X number of dollars, then they come on my side and they need to qualify for a mortgage, and then they're like, I make this much money, and then they try to show that they make more money. And you can manipulate, obviously, the numbers where you might be trying to come up with more or less, I might be trying to come up with more, and we're all looking at the same information. So it's kind of interesting.
On that, a lot of times if there's a business owner, you assume, let's say there's a line of credit with the bank. I'll often subpoena the bank to ask for the application the business owner submitted to get that line of credit and see what did they say their income was when they applied for this line of credit.
Yep.
Right.
If they're saying $500,000, and then in their discovery in the divorce case, they're saying, well, I make a straight salary, 150. We got a problem.
Right. And that probably happens all the time. And then I know from a mortgage perspective, I'll have people who tell me they make, we'll keep it simple. We'll just say $100,000 a year. And then when we look at their tax return, we see that they spend, according to their tax return, $50,000 to make 100. So then on my application, I don't say they make 100, I say they make 50.
Right.
So it gets kind of interesting. And then I know for us on tax returns, there's always that depletion and depreciation that come up, more paper write-offs. And we do add those back in as income to someone. I don't know if that comes up on your end, Ben.
It does. And it's interesting because the Michigan Child Support Formula Manual that we look at has changed over time as to what it says about depreciation. The current version of it says that depreciation on real estate should always be added back in to income, which they didn't check with the finance guys when they wrote that. But if you think about this, let's say that you've got a house. You've got a house in Ferndale and it's a rental property and you're depreciating it. But there's stuff that goes wrong with a house. Anybody that's ever owned a house knows that you turn on the faucet and the water is cold when it should be hot. And it's okay, well, I guess I'm going to be spending a few $100s, or maybe a few $1,000s this week on that. And the depreciation gets added back because it's not a cash expense. Nobody's paying the depreciation. It's not like there's somebody who comes and swallows up some of your cash flow as you're depreciating it. However, depreciation is caused by the investment of money into assets that then get depreciated over time. So you invest $2,000 in a new hot water heater, and that leads to future depreciation. But there's no expense immediately when you spend that money that shows up on a profit and loss statement or on your tax return.
Right.
It just shows up as depreciation. So if you're always adding back the depreciation, you're never accounting for the investment that you have to make to keep the thing running. So the $2,000 for the hot water heater, the $20,000 for the new roof, where does that expense come out? You actually spent $20,000 that year so that it wouldn't rain inside. Right. But that doesn't get deducted anywhere if you're adding back the depreciation like the child support formula, tells you to. So that is a problem with the current iteration. And it's a discussion that we have to have with our clients, with the friend of the court referees, with the judges, with the mediators, with the arbitrators, to talk about that, about the limitation in the current version of the formula. And it keeps changing. Every 4 or 5 years, we get a new version of it, and maybe they'll fix that. And one of the things, and this gets kind of down, deep into some weeds and where we don't really need to go, but I'll just say this, is that you asked me a question, Carrie, at the beginning as to whether or not it matters if they're a Schedule C, a single member LLC, getting rolled into their individual 1040, or if they're an S Corp or a C Corp. It matters. This issue is where it really matters, is because the Schedule C that's attached to a 1040, the individual tax return, that's where this real estate depreciation gets added back. And there's no mechanism currently specified to deal with the investment in the roof, in the hot water heater, in the new bathroom, in the flooring. There's nowhere to deal with that. So what I'm telling my clients, my business owners that are either post-divorce having an income support dispute, or that are going through the divorce process right now and have a Schedule C business or real estate that gets reported directly on their 1040, is spin that out and file a separate tax return. Because having a separate tax return gives them an extra layer of sort of protection. They can still take the money out. It doesn't change the way they're getting taxed. All it does is it helps us to separate and better identify the income for support purposes later on. Because as long as there are minor children, you're always going to have that be a fight or a potential fight. So spin it out and have it file its own tax return. It's not going to, it might cost you extra few $100s to have your CPA do it, but do it anyway, because you'll be very happy that it's not on your 1040 when the time comes to have your child support fight.
Yeah, I just think it's so interesting that everybody looks at income so different, and you assume how much money do you make is one simple, easy answer, and it's not.
No, it's definitely not. And even amongst experts, I mean, I was at a mediation last week with an expert who doesn't do a lot of divorce work, and we had an enormous difference. And we're talking about people that have an awful lot of money here. So not to shock our viewers with the dollar amounts, but I was saying that the guy's income was about $3 million. My opposing expert was saying it was about $1.7 million. And I was very surprised by the difference. And I was thinking, how can this guy who knows what he's doing from a business valuation perspective, how can he have such a different number for income? And it was the difference between talking in gross and net.
Oh,
He was
wow.
he was subtracting taxes, which you don't do when you're coming up with income for support purposes. You always talk in gross dollars, and then you kind of go from there. And he had subtracted out tax payments, not the actual tax, not what the tax return said the taxes were, but the payments that the business had written on the owner's behalf to the federal government. And so it was just a matter of not even
figuring it out.
Yeah, we weren't even talking about the same level of income. So then that's separate from, we're talking about child support, alimony. You're talking about mortgage company income. Mark would be thinking about, what's the income that I can rely on for my client to pay their bill for their budget. I mean, we're talking about, we were within the same world, we were trying to reconcile it, and they were coming out so different. So your definition of income is critical.
It is. That's why I thought this would be a really good topic, because it is so different.
Then one more thing I wanted to make sure that we cover, because there might be a business owner who's listening to this and thinking, well, wait a minute, I'm thinking this through. If I get divorced, you're telling me I'm going to have a valuation expert looking at my business to tell me what it's worth, and I have to pay my spouse portion of that. But then on top of that, you're going to tell me what I'm making or should be making, and I'm going to have to pay support based on that. I want to touch on that issue a little bit, and I'm using air quotes, so if you're listening on the podcast, air quotes are double dip issue. Can you explain, just on a basic level, what is when lawyers or experts talk about the double dip, what are they talking about, and how does it come into play in the income discussion?
Okay, I'm going to try to do this in less than 3 hours. Um,
So we're
Just
gonna need a
identify,
part C. We're gonna
yeah,
need
we're
a
just,
part C.
we're just identifying the
Yeah.
issue so that when people hear it in their meeting with their lawyer, it's not a total foreign concept.
So of all the career paths that I could have chosen, art wasn't one of them. Yet here I am with a notepad
Being an artist.
and a Sharpie.
It may or may not show up on the screen, and it definitely won't show up on the
On the podcast.
podcast, but
So
you do what you got to do.
So we do have
it's
this
not
on
even
a
showing up on the screen with my virtual background. Okay, so
Yeah.
what I have drawn is a circle. It's kind of a circle. I don't have a compass here with me, but we're going to pretend that that's a circle.
It was pretty good.
And that circle represents all of the income that an owner operator, let's just pretend that it's a dentist who owns his own practice, okay? 100% of the practice. And let's say that he makes 500 grand a year. So that circle represents $500,000. This is a pie chart,
Right.
okay? And what we do when we're valuing a business, there are 3 ways to value a business, and I'm not going to go into how they all work, but one of the 3 ways is by looking at the income stream, and we start with the $500,000, and we say, okay, what would we have to pay somebody to come in and do the work that this dentist is doing, to see the patients, to run the practice, to hiring and firing and management, administrative, and all that stuff. What do we need to pay somebody to come in and replace the labor efforts of this owner operator so he just becomes an owner who sits on the beach in Naples and collects whatever's left over after all the expenses are paid? And one of those expenses is the guy that's actually going to show up to work every day and put his fingers in the mouth of the person sitting back in the chair.
So if you wanted to replace the business owner and pay somebody to do everything he or she does, that's what you're looking for.
That's what I'm looking for. And let's just say that number is 350 grand. Okay. So we went from having a complete pie to now we have a pie that's divided into 2 sections, 350,000 and 150,000. Look at that. I can do math. Okay. And
I think we're giving up on your picture.
there it is.
Oh,
There we
good
go.
job.
Okay. All right. So what do we do then? The 350 is what we call the reasonable compensation for the labor efforts. The 150 is what the owner gets for just being an owner, for putting up the capital to start the business and the investment of the dollars into the business. They deserve a return. That's the 150. And we take the 150 and we feed it into our valuation formula, and we do the voodoo that only we do. And the 150 magically stops being an annual cash flow amount and turns itself into an asset that you then put on the marital balance sheet. And let's say that asset is worth $400,000. So now we have converted $150,000 a year in gross cash flow into something that sits on the marital balance sheet next to the house and the 401k and the bank account. And that becomes divisible as what we call property. Property not meaning real estate. Property is in stuff that somebody gets in the divorce, and it goes to the bottom line of, okay, what's the stuff that he gets? What's the stuff that she gets? And if there's a difference, somebody owes somebody to equalize it. So that's where the 150 goes. Of the 500, the 150 turns itself into an asset through our valuation magic. But what about the 350? Because the 350 is not getting paid to some hypothetical third party that's in here running the practice. It's getting paid to the guy who's getting divorced, who is not just an owner, but he's also the operator. And so until he hangs up, the water pick and the drill and rides off into the sunset, he's making 350. So what we do with that 350 is we say that is the income that's available for spousal support. So the 150 goes on the marital balance sheet. The 350 is what we use to derive our spousal support or alimony. And the reason that we don't say he has a 500 available for spousal support or alimony is because we're already accounting for those dollars. The 150 of the 500 is already getting carved out and bought out on the marital balance sheet. And so the dollars that haven't been touched yet are the 350, and the way that the ex-spouse gets the benefit of those dollars is through the alimony. That is a concept.
Great explanation.
Thank you. It falls on a lot of deaf ears, unfortunately. With with mostly judges and referees, they think it's an invented concept. I've heard this over and over again, that it's a invented concept by financial people that's not real, and sometimes we'll just use the 500. But if they use the 500, then those dollars are getting used twice. Once to buy out the property, and again to generate the alimony.
Ben, have you ever had an occasion where you've testified at a trial and had a judge reject the concept of the double dip, that we should be counting the full 500,000 for support purposes, and we don't care about your methodology for valuing the business. We're looking at what this person's bringing in total?
Usually it's not that clear, the decision. Usually if a case gets to trial, that's not the issue. However, you've probably heard of the case Loutts.
Sure.
That everybody pronounces Louts, but the parties actually refer to themselves as Lutz. I think they were Russian, and I worked for Mrs. Dr. Lutz. I wasn't her testifying expert at the time, but I worked underneath her testifying expert. And that case is one of the cases that gets talked about for double dipping, because it went up to the, I think, Court of Appeals, back down and maybe a couple of times.
Yeah, I think it went 3 times if I'm remembering correctly.
Wow.
There you go. So I sat in the courtroom for the better part of a week on that case, in the back watching and having meetings when we were on break. But I've spoken kind of off the record with current and former judges, family law judges and referees, and a lot of them just don't buy the concept. Which, if you ask the finance people, if you ask me and my competitors around here, we'll all tell you the same thing, is that it's real, and we will identify what level of income is the amount to use, the 350, so that we're not double dipping for alimony. Now, all that being said, double dipping is a purely alimony concept. It does not apply at all to child support. The child support formula manual in Michigan does not recognize the concept. All dollars, the full 500, are on the table for child support. You don't get to make any argument saying, oh, well, part of it's already bought out as property, it's already in the valuation, but nope, none of that works. So it's the full 500 that goes in for child support. So double dipping happens every day for child support, and it's supposed to.
But I can say this, you can, if you settle a case, you do have exceptions within the child support formula manual for deviating, and one of those deviation factors can be how the property was allocated. So if people are using mediation or the collaborative divorce process, or just settle it on their own, my belief is that you can make that case that, hey, if we did a buyout of the business and it included the 150, we can deviate a little on the child support to bring if we wanted to, if that was what the parties agreed to, down to the 350.
Sure. Yeah, you could.
And would you never, if you said you have to use the 500,000, would you then say the business is worth nothing because you converted it all to income, or that doesn't come up?
For child support or alimony, or both?
I would say either.
So it happens all the time that there is an agreement. So for child support, the full 500 is in.
But what about as an asset then?
As an asset, So the distinction between asset and alimony and sort of that interplay is something that we talk about all the time. And some businesses, and there was a great, not to plug David, but David Mendelson gave a really, really good presentation that was, I think, pretty eye-opening at last year's AAML conference, where he said, not every business has value or is a business to be valued. Sometimes it's just a job that happens to be run through a business entity.
Right.
And that's something that is very, very true. And trying to, the key is figuring out which are the ones that are like that and which are the ones that aren't, that have actual value. And I think that concept is finally getting some traction. And sometimes we say that the full 500 is fair compensation, if it is, and therefore there is no business value, or the value of the business is just the hard assets, or if there's cash in the bank, minus if there's credit card debt or debt to the SBA or something like that. That's a fair position if it's supportable. If you've got an individual who legitimately couldn't be replaced for the 350, would need the full 500 to replace his or her efforts, then that's an incredibly valid argument and should absolutely be considered.
Well, so much for trying to make it short, huh?
Well, it was less than 3 hours, so
There you go.
we're doing better than usual.
Yeah, it just goes to show you that we could have you over and over and over, because there's so many places that you fit in.
Yeah, I've inserted myself into the process pretty thoroughly.
I would say you have, with good reason. So, all right. Well, I'm just going to say thank you to you for giving us your time. I really, really appreciate all your insight.
Yeah,
Thank you,
my
Ben.
pleasure to be here, guys.
Thank you, Ben.
Thank you
All
very
right.
much.
Absolutely.
Thank you for listening to us today. You can find us on the divorcelab.com. You can feel free to take a look at our other episodes, and you can also leave some questions or comments for us on there as well.